I've been told like, oh, you're going to blow it out. It's just inevitable. It's going to happen. I'm like, no, I'm going to grow this account. It's going to be great. I'm up like 8% on the year.
My friend Julia has been experimenting with a $5,000 portfolio through this year's down market. So this week, Julia and Jamal gave me a crash course on strategies and risks for smaller accounts. This episode's got a lot of counterintuitive wisdom for smaller traders.
With smaller accounts, you often run into the issue where you have to kind of like overexpose the amount of capital you're allocating to short premium in order to have like a reasonable number of positions on. It's an issue that like I would run into with a $5,000 account. Like in order to have 3 positions on, I would have to be allocating like sometimes up to half of my capital, which is not great. We aim usually to trade between like 25 and 50% of your overall capital to short premium, just because black swan events do happen, outlier losses do happen, and a very effective way to kind of protect the portfolio from those is by just limiting the amount of capital that you trade in the first place. Once you get up to 25,000, you can really like have a decent number of positions on, like 5 or 6 positions on.
But if you have that size of account and you have a margin, I think in that situation, you're able to do some undefined risk trades, selling some downside, selling puts, right? Selling out of the money puts or selling out of the money calls. So you have that ability to do those bigger pop trades with that size of account. That's probably the first level where you can be like, oh, I can do like a couple of different things here.
Options are like kind of inherently diversified instrument because there's a bunch of different parameters that you can actually tune that kind of change the risk profile a little bit. So even though the underlyings might be correlated, you could trade option strategies that are less correlated.
Clearly you've got an advantage if you have a larger account. So for $5,000 accounts, what are your thoughts on maybe taking a bigger shot sometimes?
It's funny, I was having kind of this conversation with Victor, I think like a week ago, sometime last week, which is, is it more educational to trade stupidly or to trade smartly? Especially when you're starting out. And I said that for me, it was really educational to trade kind of stupidly, but you have to be smart about how you trade stupidly, if that makes sense. Mm-hmm. So I think if that does make sense, I think that like taking risks are important. And when you do have a small account, like experimenting, when you're just getting started, experimenting and trying maybe even low probability trades just to get a gauge of how the market works is helpful. But the smart bit in that comes from you don't want those shots in the dark to kind of like drown your account. So it's important to like, even though they might be low probability trades, to have a really good idea of position sizing and like how much risk tolerance is acceptable for that kind of account size. Because that's something that I ran into with my $5,000 account.
What kind of positions are you looking at in there?
In there, it's definitely defined risk. And it's also probably, you could also put on like a calendar spread where you're selling vol in 1 month and buying vol in another. I mean, those tend to be pretty low amount of premium on the trade. So those are also a possibility, but definitely define risk in those situations, whether it's selling out of the money call spreads or put spreads, or maybe even, buying in the money call spread, kind of like we tend to do, or maybe even a zebra or something like that. But those are definitely more defined risk situations for that size of account.
But how is your mindset towards risk adjusted as, somebody were to be trading a larger portfolio? How do you think the mindset would change slightly?
It really should, in my opinion, like stay the same. Like your attitude of risk shouldn't really change. Ideally, like if anything, I'm trying to be more cautious with a $5,000 account just because I've been told like, oh, you're going to blow it out. It's just inevitable. It's going to happen. I'm like, no, I'm going to grow this account. It's going to be great. I'm up like 8% on the year. From a mathematical perspective, your ideas of risk shouldn't really change. Like they should really just scale by adding more positions or by, trading more expensive strategies once you do get a larger account or once you're dealing with a smaller account.
Have you noticed any type of, maybe an emotional change in terms of adjusting your risk when you're using larger capital allocation?
Oh, yeah. Have I? Are you kidding me? I mean, you definitely notice a big difference. You're able to do a little bit more. You're able to sort of, like you mentioned a second ago, you can do a strangle in those situations. You can do it in a bigger name. There's nothing that sucks more when you're trying to do like a size, like a strangle or something, and that capital just doesn't quite allow you to do it, right? Like you definitely notice a little bit of a difference on how you allocate your capital. Like I said, you can get wider strikes on, those defined risk positions when you have that $25,000 account. And yeah, you could probably do a straddle in a small account, but those can get a little dicey at times. So those are ones where you're really kind of you're really kind of sizing that up very differently.
When I first funded my first account in college, I just had like a couple $1,000s in savings. And I remember thinking at the time, like, man, I wish I had $25,000. I could be doing this, this, and this. But I mean, in hindsight, it's maybe a great thing that I didn't have access to that kind of capital. Do you think the amount of capital you start with is a good thing or bad thing in terms of 5,000 versus 25,000?
So I can totally relate to that, because like when I had a very small account or when I didn't have a lot of capital, I would always think like, oh man, I could be putting on all these crazy strategies, or I could be trading all these underlyings. And like having the small account, originally I was like kind of annoyed at it. I felt like there was a lot that I couldn't do. But again, with options, like you have a lot of strategic diversity. So you can really like, you know, find a way to trade any underlying, but your arms are going to be kind of tied in other ways, or you can trade pretty much any strategy, but you kind of have to get a little bit more creative. So I think especially starting out, having a smaller account, as long as you're very mindful of the outlier risks and just position sizing risks and that kind of stuff, I think it's a really good place to start because it makes you think a little bit more creatively, I think.
Julia, Jamal, thank you. Click here to learn about some of the defined risk strategies Jamal was talking about. So for those of you with $5,000 portfolios just getting started, company Tastyworks is running a promotion. Get a $100 cash bonus for depositing at least $5,000 into your Tastyworks account. Learn more about their terms and conditions in the link below.